Welcome to the deep dive video update. And I like to explain the title of this right off the bat. It may be a little bit different context than what you thought if you're seeing this video for the first time. Every week I do a video each day. I do a couple of different weekly videos. This video is to go through some charts that, first of all, are unique just to this video. Also, to go through some charts that maybe I didn't talk about in any of the other videos, and I put them in here, and we have to look deeper because the other charts that are only in this video just kind of give us some information about what's going on in the market. And some of the charts that are used and then not used, we have to see, are they still telling us anything that could be useful? This is being prepared for Tuesday, January 21st. This first chart is just for information. Don't show it in any other videos. This is a longer term range of the VIX. The VIX is a fear gauge, and when the VIX is going up, that means there's a lot of fear in the market. And if it goes above 20 and stays above 20, that's when the market's really under some pressure. And you can see during the great financial crisis, we had a higher range. Back after the COVID crash, we tried to improve there, but then we went into 2022, where we also spent that year and even into 2023 in a higher range. Now we're in a lower range, and we've been going down as the market's been going up. Now, right around the time of the summer when the tech sector and semiconductors started to underperform a little bit, and we had that big down day in August, we've seen that leading up to the election and then going into the end of the year, the VIX has been going back up as far as its range is concerned. Then as the S&P was setting new all-time highs, it started to go back down. Well, lately it's been under some pressure. 2025 has not got off to a real bang-buster start, blockbuster start. I forget how to use that word. And so we are going back up right now. Now we're still below 20. And so that's positive when you look at it above 20, below 20. But the fact that this is going back up, that just means stocks are under pressure. If we continue to go up, and as I record this, we had a pretty good week and things look to be improving. If that can continue, then we should see the VIX start to turn and come back down. All right, and then another study with the VIX is a correlation between the S&P and the VIX itself. Sometimes we look at the VIX all by itself. There's some studies that I look at. There's some other sentiment gauges that I also look at. This is another one. And when we get above this dashed line, that means a lot of fear is coming into the market. The VIX is very high in relation to what's happening with the S&P. And sometimes we might be seeing something here that we're not getting in some of the other studies that we do. Even this, even though this is going up right now, it's still not above this dashed line. So I have not really been showing this. But as we've been under pressure, we have seen this correlation going up. We look at a ratio between the VIX and then the VVIX, which is like an indicator of the VIX. And as a general rule, there are exceptions. When this is going down, that's when stocks are going up. And when this is going up, that's when stocks are going down. We've been pretty choppy throughout 2024. We are starting to go back up. That means the VIX is moving faster than the VVIX. And we don't take a lot in reading this chart. We just mainly use this for information. If we start to go back up and the VIX starts to drop, we would probably see this ratio continue to go, or at least start to go down. Okay, then we want to see how fast is the VIX moving, and this is more short term. And when we get above the 70 level or below 30 here, that just means that we're moving up or down pretty fast. Well, right now we're not near one of those levels, so I haven't been showing this. And then we look at the volatility of stocks as measured by the VIX, and the volatility of bonds as measured by the MOVE index. And I mainly follow the red line, which is the moving average. Now, in a general sense, when this is going down, that means volatility in stocks is going down in relation to the volatility of bonds. And then typically you can see an opposite reaction here. When we were going up in 2024, but the S&P was also going up. Right now, we had been going up a little bit. We're starting to flatten out as we've been seeing interest rates going up and stocks under pressure. If that starts to change, we might see this ratio come down. And then if it stays that way, the moving average then would begin to come down as well. This comes in and out of the daily video kind of on an as needed basis. It's a risk on to risk off ratio. When the market's really strong and really moving higher, the risk on will outperform the risk off ratio. Well, lately we've been just chopping around. And so I've dropped this from the daily video for the time being. If we show some real conviction, either to the upside or the downside, then I'll start to show this again. And the same thing is true here. How are large caps and small caps performing compared to each other? This was really going up, meaning large caps were outperforming, and then large caps came under some pressure, as did small caps. And so far in 2025, we've been just chopping around here. We're not really getting any convicted signal with this. Then this is more for information. Going back to the previous all-time high set in January 2022, we're up 24.45% from that high. Then we set a low in 2022, and we're up 71.6% since that low. We set another low, excuse me, in October of 2023, and we're up over 46% since we hit that low as well. This is just to kind of keep a numerical view of things. Then stockcharts.com, every day they come out with technical alerts. These are the alerts for the whole week. And we start from the bottom, that was Monday, and then we end at the very top, that was Friday. And when we see a lot of red, that's more negative. When we see a lot of blue or green, depending on what color you see here, I always say that because some people see different. I kept saying, oh, this is green, this is green. And somebody says, nah, I see blue. So that's why I say that. But these are more positive days when we see green or blue, more negative when we see lots of red. And so we just use that more color just to see in the bigger picture what's happening. Now, stockcharts.com also has this score system that they use called a scooter score, and it's a scale of 0 to 100 because the idea behind technical analysis is it was supposed to remove emotion and you're just supposed to look at charts to make your decisions. Well, people can, if they're more positive on things, you can look at a chart and come to a positive conclusion. You get confirmation bias. Or if you're a perma bear, no matter the chart might be going straight up, you see something negative. Well, this tries to take that a step further, just using basic technical analysis tools and indicators, and then scoring different indexes on a scale of 0 to 100. And then I look at 5 different indexes. I look at the S&P, that's the foundation of everything I analyze and all the strategies I teach and do in my program. And then I look at the Dow, because that's considered to be the best of the best stocks. Then we look at the QQQs, which is the NASDAQ 100. I look at the mid caps and I look at the small caps. And then what's looking the best right now? Well, when we're really strong, you see we're coming in at 81.7 right now. When the QQQs are strong, we would be up into the 90s. And we got there earlier in December, and this was looking pretty good. But this right now is still the best looking index based out of the 5 that I look at. Then in second place is the S&P 500 at 77.6. Now, the QQQs, that's tech, where the SPY, it also has those 100 stocks that are in the QQQs, but it's 503 stocks and it has value stocks. It has stocks that aren't as big, aren't as influential. So it tends to lag a little bit when we're seeing strength. It also tends to hold up a little bit better when we're going down. It's coming in second place at 77.6. In third place are the mid caps, coming in at 73.8. Then we have the Dow at 73. And then last place. Now, there are improving. You can see we were well under 30 here with the score of the small caps. So they are bouncing back up, but they're still coming in last place when we compare them to other indexes. This is the IWM. This is the Russell 2000 small cap ETF at 47.2. It'll be more positive if we could go above 50. And then if we could continue to climb from there, that would help the small caps or at least show that they are doing better. All right, then I have a short-term rainbow, and this kind of comes in and out of different videos that I do. This is longer term because I want to get a bigger picture, but the moving averages are short term, going from 10 periods up to 50 periods. And as the market was under some pressure, we actually dropped below this rainbow. we dropped below the 50 period moving average here, and that was turning the intermediate term trend to negative. Well, we had a nice little bounce this past week, and so we were able to come back up and we're above the current rainbow. If we can stay above that and keep going up, that'll keep the lines going back up and flatten them out. Then we look at a thing called the boom indicator, because sometimes when we're moving really fast, we get too far away from certain moving averages. And in the short term, I use a 20 period moving average, and this measures how far away are we, either above or below that moving average. And I use this like an oscillator. So we get extreme positive or extreme negative. We're not extreme right now. For the intermediate term, I use a 50 period moving average, and we're coming back above zero. So we had dropped below zero. That was turning it more negative because we dropped below the 50-day moving average. Now we're getting back above the 50-day moving average. So this is improving. And then for the long term, I use a 200 period moving average. And even though we fell down here, we never did drop below zero. Are still well above the 200-day moving average. So I only use this chart when it's giving us an extreme positive or negative reading. So this kind of come in and out of the daily videos. Intermediate term is another rainbow going from 50 periods up to 100. We came down and the 100 period moving average was actually holding a support on a closing basis. And that right now anyway appears to be the support that we've been bouncing up off of. So we've been going back up. We cleared back above the 50-day moving average. So this happened pretty quickly. So we're not really seeing any jumbling up of the lines. If we can keep going up, the lines will smooth out and start to go back up. If we had dropped below this, then the lines will start to cross over each other and look more like spaghetti. But since this happened relatively quickly, we're not seeing an awful lot of damage to this point done to the intermediate term trend. And then we look at Bollinger Bands, and there's a whole different you have a whole catalog of ways that you can use Bollinger Bands. This is just one implementation right here, and it's called the percent B. And I use this like an oscillator. If we close above or below the upper or lower Bollinger Band, we're not there now, so I haven't been showing this chart. Now, we were dropping below the midpoint, and that's more negative, but now we've been able to cross above the midpoint as things are turning a bit more positive. Then we look at the CMB composite index. I use this like an oscillator. It's going up as we've been improving, but we're not quite to this black line. If we keep going up with the S&P, then we'll get above this black line, and then I'll start to show it in the daily videos. And we want to measure how far away are we from the 200 period simple moving average. And we had been coming down, but it stayed green. We never fell below that. We never fell underneath the 100 period moving average. So this is showing some improvement currently. And then we measure things from that October 2023 low that I was talking about until where we closed on Friday. And this is kind of I do this by hand, so I'm probably going to come up with a different figure than what I came up with earlier, just to give us an idea of what kind of a percentage rise have we seen since those October 2023 lows. Now you notice in here, when we hit that high in July and then we started to decline and then we had that end of the world day here, we were getting close to that 10%. And then we saw the smart money coming in and buy, and that pushed us up out of that. Well, as we hit our high in early December and we've been coming down, I'm starting to track this because we were going lower, lower, lower. We were breaking previous lows. We were not going back and breaking above previous highs. So I kind of put it right here just to see, are we getting close to that 10%? And to this point, especially if we keep going up, we did not. We got a little bit over 5%. All right, then another momentum oscillator that I only use when it's extreme positive or negative is the Connors RSI. And it's pretty spastic day in and day out, but I only use it if it goes above the upper black line or below the lower black line. Anchored moving averages, which try to project forward. That's how they're different from regular moving averages here. And I just marked these since we've been in an uptrend. These are anchored back to previous lows just to see, are some of these areas going to end up providing some kind of support? We actually broke below this short-term support level, but now we've been able to get back above it. The other takeaway from this is you notice all these lines continue to go up. And so that just still shows that we're positive longer term. This was really handy a week ago because we were coming down to the 100-day moving average. We broke below the 20, we broke below the 50. But you notice on a closing basis, we closed just a little bit above it. Then we actually went below it, but closed back above it. And we were able to close above it. So three closes in a row were above the 100-day moving average. And that told us that, okay, maybe some real solid support is being built here. Well, now we've been able to come back up. We got above this pivot point and we're getting well further away from the 100 period moving average for right now. And I use this simple and exponential version here. And so I dropped this from the daily video, but I just wanted to explain it here because we were really focusing on this a week ago. We look at the S&P 500 compared to the S&P 100. The S&P 100 are the biggest stocks that make up the S&P 500, just to see if there's any real divergence here, either positive or negative. Now, when we've been going up, the 100 has been outperforming the 500 with other studies that we look at. What we're looking at here is, okay, is one going up while the other is going down, and we're not really seeing that. You can make a little case here that we're a little bit closer to this previous high than we are with the S&P 100 before we had that big downward move. So that we need the S&P 100 to actually do better, but it's showing that it might be at support if you watch the intermarket analysis video update. All right, then long term, another rainbow going from 50 periods up to 250 periods. We came down into the rainbow, but haven't stayed there for very long, and now we're back up out of the rainbow. The lines have slowed down going up, but they haven't rolled over yet. So this just shows the long-term trend is still positive. A long-term oscillator called a special K, just like the cereal. Even though this has been coming down, it started to come down in about halfway through December. It's still above this red line, and that's really what we look at. We don't see many crosses above or below this red line, so I don't show this chart. I look at it every day. I really only start showing it in the videos if some kind of a cross is happening. Then we want to keep an eye on the relationship between US stocks and European stocks, and Germany has the biggest stock market in the EU. And we could see up here a weekly chart of the S&P, a weekly chart of the German DAX, where they're kind of getting a little bit off of their strong correlation right now, but they're still having a pretty solid tendency to go in the same direction at the same time. Meaning if Europe is up, the US is up. And German, you can see here, we're setting all-time highs with the DAX right now. They're doing really well. Europe had a good week this past week. All right, then this is some Fibonacci retracement levels. This is going back to the December 6th all-time high that we set. And I use these on an intraday basis. Some folks may use this just with closing prices. And we're down off of that high, but we haven't even come close to being down to this 38.2% retracement level. So there's been no need to show this chart. A broad market measure where I focus a lot on the VIX because it applies to the S&P. Well, we have a thing called the VIXN, which applies to the NASDAQ 100. I don't look at this one as much. I do keep an eye on it, but I don't do all the studies and analysis like I do with the VIX. And we look at the S&P on top, and then we look at a ratio between QQQs, which is growth, and the diamonds, which is the Dow, and that's more value, the best of the best stocks. And there's some growth in there too, because you have stocks like Microsoft, Nvidia was recently added. And we just look at the correlation between them, and we see that it had been pretty strong. They were going in the same direction at the same time, right at the beginning of 2025. That's starting to come down just a little bit right now. So we'll keep an eye on that one. We want to keep an eye on the transports. They've been really disappointing in 2024. That's the red line here. The Dow is continuing to outperform the transports. And there's a lot of different studies that I go through, mainly in the intermarket analysis video that goes more in depth with the relationship between these two. We want to keep an eye on regional banks. These are smaller banks. And then what is their ratio to the financial sector? And we've been going sideways. We're not seeing any real strength here, but we're not really seeing any weakness to this point. And we are in an uptrend with this ratio because this was Silicon Valley Bank and Republic Bank and New York Community Bank. If the small banks start to have some problems because of rising interest rates, because they have billions of dollars of unrealized losses because they locked themselves in at much lower interest rates, And now they're going to have to swap those over at higher interest rates, and that could really affect their bottom line. So we want the financial sector to do well, and we want this ratio to also do well. And I look at a ratio between staples and tech. There are some times when I show this in every video, but we've been just really choppy lately. One day we're up, one day we're down. Staples is defensive, where tech is growth. And when this is going down, that means the tech sector is outperforming staples. And we want this to continue to go down, but we've been so choppy lately, I kind of dropped it from the daily video for right now. So the takeaway here is just the overall trend is down, and that's positive for the tech sector and positive for the market. Then a rate of change chart here. I just showed one this week. This is 250 periods. So it's Friday's close, then going back 250 periods. Long term, we had gone above the blue line, then we started to drop below the blue line. Well, we saw a little bit of a bounce back up with this long term. And the long term trend is still positive, but when have been going down lately, it shows a little bit of weakness creeping into the long term trend. And we want to keep an eye on that because it starts as subtle weakness. And then if it continues to build, that may tell us that, okay, we're starting to see more weakness. And now the long term trend is in danger of actually changing from positive to negative. Really watching bonds a lot lately. This is cash, 1 to 3 month T-bills, and 3 to 7 year bonds. When this is going up, that means there's inflation concerns, there's interest rate concerns, and we've been seeing this going up, and it is in an uptrend. Well, finally, this past week, interest rates started to come back down, and we started to see this ratio come back down slightly. We also look at TIPS, which are Treasury inflation protected securities. When these are going up, that means folks are concerned about interest rates going up and inflation increasing. Not seeing as much of a change here. We're still in a downtrend when we compare it to 3 to 7 year bonds. So this is not showing us that there are a lot of inflation worries. But then we switch back up to further out bonds, TIPS, and then 7 to 10 year bonds. This is still a concern, even though it's been dropping back down lately. We want this to continue to fall. That would, right now, in this environment, would be more positive for stocks. Let me look at the long-term bond ETF, like the 30-year bond, and that's in blue, which has been under a lot of pressure, but bouncing up lately. We compare it with the S&P, and then we look at the long-term correlation, which shows that it's getting stronger. They're going in the same direction at the same time. And even the short-term correlation based on 10 periods is also starting to get stronger. So if bond prices are going up, stock prices are going up, and vice versa. We'd use that same basic idea, but we compare it to the QQQs, where on this chart, the TLT is red. And we're pretty much neutral now with our correlation because the Qs have been holding up a little bit better than the TLT lately. And then another relationship between the US and Europe, again, Germany. We take the US 10-year yield, subtract the German 10-year yield. That gives us a line up here. And it's, since US rates are higher, it's positive. And believe it or not, we can compare that to the US dollar index. And we see that there's a pretty high correlation between the top chart and the middle chart. This again is just showing us the interplay between interest rates and currencies. And it's when we really start to see this correlation go crazy down, that's when we're like, okay, what's going on? But right now, it's not really giving us any alarm signals. We keep an eye on the 2 year Treasury yield, which had been coming down. Now it's starting to go back up, not really giving us a lot of additional insight right now. And then we do a complete apples to oranges comparison of European stocks with American bonds. And they had been weaker lately when the Eurozone ETF had been underperforming the price of bonds, if you can believe that, because bond prices have been going down. But now we're seeing a bit of a bounce. We're coming back up more into the rainbow. And this also just tries to show the interplay between European stocks and American stocks. The 2 to 10 year yield curve now went back to being normal. I'm probably going to drop this completely here unless we really start to see a shift. But this had been inverted for quite some time, over what, 2.5 years, I believe. And now it's gone back to being normal. We're also seeing that same thing with the 10 to the 3 month yield curve. It's gone back to being normal as well. And then I have a number of things called possible positive scenarios. These are really what I used heavily in 2022 when we were screaming to the downside and we were getting oversold and it looked like maybe we were forming a base, and I would use a lot of these charts. Well, a lot of these charts still appear in the daily videos, but then there's some additional charts that I don't show in the daily videos, but I do present here. And I have a couple of different ways of looking at those stocks that are above their 200-day moving average in the S&P. We were getting a little bit concerned here because we were coming all the way down to 50. Well, if we drop below 50, that's 50% of stocks would be under their 200-day moving average. That could mean things are turning more negative. We came right down to just about 50, and we've been bouncing up since then. So we're seeing an improvement in the longer term trend here. Now, I also use this like an oscillator if we get an extreme positive or negative reading, but we haven't seen one of those for quite a while, going back to 2020 and into 2021. That same basic idea is used to look at those stocks above their 50-day moving average. We're crossing back above 50 now, so this is starting to turn back more positive for the S&P. We look at the mid caps, also showing an improvement here, and with the small caps, also showing an improvement after we had been seeing some weakness. And then I also quite often show this every day in the daily video, but we've been so choppy and not really showing any real conviction lately. This is the ratio between the S&P and utilities. When this is going up, the S&P is outperforming. When this is going down, utilities are outperforming, but it goes up one day, down another day, and it hasn't really given us a lot of additional insight lately. Thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. Have a great weekend, and I will talk to you in the next video.